LinkedIn
Yeah.
to see.
Zoom is thinking. Oh, shit. No, fuck. Is this working? I can never tell with Zoom.
It says the content is being shared to a third
Yeah,
party.
but is it going to the right place? That's the question.
Let's see.
All right, that's working. All right, welcome everybody. If you caught me logging in and swearing, then yeah, that's how it rolls. I am Neal, one of your hosts here with me, Serena, as
Hello.
always. And this is the $1 Trillion Show. So let's make sure that things are actually working. And that seems to be okay. This seems to be okay. This is working. All right. So I think we're good to go. Okay. Also, it's just that when Zoom goes live, it redirects to the wrong page, which is a whole thing that I have to fix at some point. But the stream is going out in the right place. That's all that matters. All right. So let's talk about the $1 Trillion Show. So, like I said, I'm your host, Neal. What's the mission? Why is it the $1 Trillion Show? It's the $1 Trillion Show because that's the mission, to save Americans $1 trillion in taxes. Now, I admit that's not going to be all at one time. And we will build up to that over time. And, we've already done hundreds of millions probably over the last many years. But the, I have bigger plans, So, I want the total to get to $1 trillion. And, it's a little bit of an arbitrary number, but it's also a little bit of planning. I've done the math on the IRS statistics. Every couple of years, the IRS rolls out the statistics of recent filings and everything, and they will show, how much of each type of tax return filed, by line number, actually, the different aggregates, and they'll separate it by industry categories and things like that. And I've done some basic analysis. Said, okay, what if everybody did tax planning? What if everybody optimized their situation so that they weren't giving away money they didn't have to? And $1 trillion is totally doable. One of our older shows actually went through the math on some of that, but it's completely possible if everybody were to just get on the ball and do their taxes smartly. So part of what we're trying to do here is to scale that tax saving strategies through technology, through things like this, where we're talking to people, through tools that we're putting together, through educational content, courses, all these sort of things. And that's the how of how we're going to get to $1 trillion. And the who, this is me. I'm Neal. I got into taxes because of my own tax problems, which a lot of people can relate to. I woke up one day in 2007 and opened a letter from the IRS saying I owed them $1.3 million. So that was my start of my tax journey, because I didn't know anything about taxes, and then got myself into trouble, fixed my own problems, and in fixing my own problems, I found the whole world of Wall Street tax planning, essentially. So, how can you start saving on your taxes? Well, take our starter course. It's very easy introduction to setting up your life in a tax efficient way, and you can get that inside of our Explorers group, which we'll get into later on. So that's what to do. In the meantime, we'll answer some tax questions. We'll do some review of things. We've got a couple of news items to go over. But I already have the answer to every tax question. And Serena, what's the answer to every tax question?
It depends.
It depends. It depends on facts and circumstances. So facts and circumstances dictate the reality of the situation. So I was just reading a tax court case earlier, like 30 minutes ago, because that's the kind of stuff I do. There was a guy who I forget what his business was, but it was a side business. He made $7,000 in, and then he tried to write off Rolling Stones tickets. He wrote off going to basketball games and you know, buying concessions and stuff. And so, you know, so there's a way to do things and there's a way not to do things. He did it in the way not to do and managed to get slapped in tax court. And the whole thing was like a $3,000 question, and he decided to go to tax court and go through the whole thing, which is surprising. Most people don't actually do that, but but he got everything denied, and now he's gonna have to pay the difference and all that kind of stuff. So don't do things in the way you're not supposed to do them. So, as an example, entertainment like basketball games and like uh, Rolling Stones tickets are not deductible, just at all. Doesn't matter if they're anything, because under the Tax Cut and Jobs Act of 2017, entertainment became non-deductible, as opposed to before then it was 50% deductible. So all the box seats that companies used to have used to be at least half deductible, but not anymore, ever since 2017. And it's looking like that it's going to remain that way because one of the things the new administration wants to do is to pass a new reconciliation bill that affects taxes and make the Tax Cut and Jobs Act permanent. The Tax Cut Jobs Act is the name of the Trump reform back in 2017, which is coming up on expiration in a couple of years. So they want to get all this done, and there are a number of provisions that are expected to change. So if you live in a high tax state and you've been hit by the $10,000 cap, they're expecting that's going to go away. But we'll see, right? Some legislation has to be passed, and the and you know hold your expectations until they actually do something. That's kind of the bottom line. Because politicians are all talk, right? Until something happens. So that may affect some things that are in our tax season that we're starting right now. So on Friday, the IRS announced that they are opening for electronic filing for individuals on March, or not March, on January 27th. March, I would go insane. January 27th, 2 weeks. So in 2 weeks, we'll be able to file 1040s. As of tomorrow, we'll be able to file corporate returns. Um, the But that's usually not such an issue. So everybody wants to get their personals started. So important dates: January 27th, IRS opens for e-filing for most people. January 31st is the day to get 1099s and W-2s filed and in the mail if you're paying other people. March 17th, so March 17th, normally it's the 15th, but this year the 15th is on a Saturday, so March 17th is the Monday. So that's when pass-through entities are due. That's your S corporations and your partnerships. April 15th is your regular due date for individuals and C corporations. And obviously, if you file extensions, you get an extra 6 months. So March turns into September, April turns into October. The pass-throughs are always a month ahead of the individuals because the individual has to receive the information from the pass-through in order to complete their tax return. And then if you do file an extension, remember it is only an extension to file paperwork. It is not an extension to pay. They want their money. that's the short version. So those are the important dates for this tax filing year, and we are in 2025. We're filing on behalf of 2024. We're always a year behind in the tax world. So I'll have a lot of conversations with clients and said, so what did you do this year? And they're thinking about this actual year, 2025. It's like, no, when I say this year, I mean this year that we're covering in taxes, which is last year. And I know that gets confusing, and I need to be clear about that sometimes. That's just how we talk in the tax world. Okay, so before we get into the questions, I did want to hit this thing that I saw on Twitter just today, actually. So this is a situation that I have seen play out a couple of times, and it's worth going over because you'll hear a lot of things in the tax world. It's like, well, if you could do this, you could do that, you can do the other thing, and it'll be so awesome. This guy, who apparently was German, decided to move his entire life to Cyprus to escape Germany's 50% tax rate. And here's 21 brutal realities of tax haven living that nobody warns you about. I'm not going to read everything word for word here, but basically, Cyprus 12.5% tax versus Germany's 50% looks great, right? So he moves all there. He moves himself, his business, and all this kind of stuff. And he built himself a technically perfect life that was practically impossible to live in. Perfect example, a simple squat rack took 3 weeks to arrive because of EU plus island logistics. That's what it hit me. I optimized for numbers, not actual livability. And there's calendar restrictions as far as when you can be on and off the island in order to maintain residency to qualify for this tax haven status. Being far away from innovation hubs, it was a real impact. And then he runs into a crisis of identity and whatever. So I think this was the most important part right here. You end up living perpetually at 70% commitment, not fully moved in, not fully invested in the community, not fully building a life. Everything stays in the strange limbo state because deep down you know this is just a tax strategy masquerading as a life decision. So I think that was really poignant in that one part. And so I tell people a lot. I tell people all the time, don't let the tail wag the dog, right? Tax strategy, yes, super important. But when it comes to things like uprooting your entire life, is the juice worth the squeeze? A lot of times there are things you could do that might make sense on paper, but will make your life materially worse. So when you talk to average people not in the accounting world about tax strategy, the one thing that they know is like, well, if I have a business and I have a whole bunch of money at the end of the year, I could spend a whole bunch of money and then I can deduct it on my taxes. Like, yes, that is true. You could do that. You could. There's guys on YouTube trying to sell private planes on that basis. But then there's all the other stuff that comes with buying the stuff that you just bought. It's like, one, you don't have the cash anymore. Two, if you finance something, then you have the payments associated with that. And three, if it was something that you weren't planning on buying anyway, or wasn't part of your business, or whatever the case might be, then you're just wasting money. So it's like, what are you doing? So there's a time and a place for things, and you have to look at it kind of holistically and figure out, does this strategy match what I'm trying to do, and B, my actual life? And you just got to keep those things in mind. So sometimes the answer is yes, and you should go ahead and do those tax strategies. Sometimes the answer is no, and you should not. But you got to look at things on a case by case basis. All right, so that was my pontification for today. So, Serena, what do we have in the defense department this week as far as people coming in with questions? We've been having a lot of questions lately. We have team meetings every morning, and we go over all the emails that have come in over the last day and everything. It's been a lot.
Yep, a lot. It looks like we have a investment and wealth management question.
Okay.
So a client wants to know, how does tax loss harvesting work and when should it be considered?
Yeah. So tax loss harvesting, this is related to capital gains. So usually we talk stocks, but it could be bonds, it could be a lot of things. So along the course of the year, you sell stocks. And let's just use that for this example. And you have a profit, you sell another thing, you have a profit, you have to sell another thing, you have a profit. Great. So now you have this big gain for the year. And then at the end of the year, you look at your portfolio and say, well, I've got these three other things that I haven't sold, but I'm down from when I bought them. So I'm in a loss position. And so to harvest those losses, you sell the losers at the end of the year to offset as much as possible the gains that you have. So if I have $30,000 worth of gains and I sell $23,000 worth of losses, now my net gain is only $7,000. So that's how you harvest the loss that you have for tax purposes. That's why it's called tax loss harvesting. So there's a couple caveats to go along with that. So caveat number one is that if you want to rebuy into that position, then you have to wait at least 30 days to avoid what's called the wash sale rule. And so if you buy it back, so if you sell the loser for $23,000 loss and you buy it back within 30 days, that $23,000 loss goes away, just poof, gone. And so you have to wait at least 30 days in order to buy it back. And there's some history as to, even if you replace that with a substantially similar issue and whether that's allowable or subject to wash and all those kinds of things. So, just be careful about it. But that's the basic idea, and it's super useful if the circumstances apply to you. Now, there is a platform, a new platform that we've had a relationship starting with called FREC, FREC, and what they do is they do direct index investing, which is pretty cool. So instead of buying an S&P 500 ETF or an S&P 500 mutual fund, what it does is it goes in and it buys 500 different stocks. And so you just directly own all 500 and you simulate that index. And their magic sauce is that they will tax loss harvest for you automatically over time. So, if, stock number 372 ends up becoming a loser from your entry position, then it'll sell that off and build that loss into your overall portfolio. And then over time, we'll buy back in after the wash sale rules expire and everything. It's pretty cool stuff. So if you're interested in that kind of thing, you need, I think you need at least 20 grand for that for their service to actually work. But if you have decent investable assets, it's a pretty cool platform. I'm starting to test it out myself. So so that automated tax loss harvesting, I think, is one of the trends of the future in order to mitigate that problem. Because the thing with capital losses is that if you have a net loss, so let's say we don't have $30,000 worth of gains, we just have the $23,000 loss. You can only deduct 3,000 per year, and the remainder rolls over to next year, and rolls over to the next year, and rolls over to the next year. So for myself, part of my $1.3 million was stock trading, which I was doing poorly. And so I've got a $100,000 loss that's from 2003 that's still rolling forward, $3,000 a year I'm taking every year. And we'll probably just continue that way forever. I still got like a decade on it, even if it's been 20 years. Uh, so because of the rollover characteristic, you can build up those losses over time, and then when you do have a gain event, then it will absorb those losses in that year that you have the gain. So tax loss harvesting is a great strategy. It's very accessible in that anybody can do it, as long as the circumstances apply. Now, obviously, we're in January, so too late for 24 to do tax loss harvesting, but definitely keep it in mind for now and into the future. So yeah, that's one where it doesn't actually depend. The only thing there is that if it applies to you or not. So worth doing if it applies.
So if you have a loss, the most you can pull is 3,000 per year?
Net, yes.
Yeah,
So
okay.
so yeah, if you had 100,000 of gains and 150 of losses, then you would have $3,000 loss and 47 would roll over to the next year.
And there's no way around that. You just have to stick with those rules, right?
Well, the only way around that is to be a professional trader, and then you can do mark to market. And then instead of looking at your individual gains and losses, you're looking at your portfolio balance. But that's very, very few people would apply to. You have to demonstrate that you have basically a professional trader. You're in the markets every day and you're doing stuff all the time. So it doesn't apply in most cases. But then it converts from specific trades to overall portfolio.
All righty. So we have a small business tax question. A client wants to know, what are the tax advantages of reinvesting profits back into the business?
Tax advantages.
Uh-huh.
So if you have, well, it depends on the tax filing type. So normally, if we're talking a pass through, so it's a partnership or an S corp or even a sole proprietorship, then sole proprietorship doesn't make any difference. S corporations and partnerships, that reinvestment activity creates either basis or capital, depending on which form you're looking at. If it's a C corporation, which is relatively the minority of situations, then you're putting in paid in capital, which you can then potentially take out later. So fundamentally, there's a couple things that go in. So when you invest into your company, you are building that pool of investment that you could later take out, tax free, because it's It's people call them loans, but they're not really loans. Um, um, you know, it's just a capital contribution or capital distribution. So as you build that investment into your company, it allows for the taking of, if you have losses, it allows for the taking of losses um, from that entity, or it allows for withdrawal of funds in a tax-free way. Because if I put in 10 grand, I can take out 10 grand because it's the same 10 grand essentially. Or it, depending on the setup, it might impact, a sale. So if you're selling your business, that your basis might affect your net capital gain on the sale. So, those kind of things are all involved in that reinvestment. Now, I will caution everybody in the sense that entrepreneurs have a very bad tendency to over invest in their company because they're fundamentally very optimistic. And that's good because you should believe in what you're doing, but you have to make sure that your business is generating enough money for you to actually live your life. And if it's not, then there's something wrong with the business. And that's not unusual. A lot of businesses have something wrong with them. So, one of the things that we do with our profit first consulting is to talk to business owners about how their business is operating on a cash flow basis to make sure that it is throwing off enough free cash flow in order for the business to support their lives. So what we see a lot, and I've been guilty of this myself, is it's like, oh, this next big thing, I gotta put 10 grand into it, but then it's gonna be huge. And something always happens, right? And there's just a cycle of doing this over and over and over again. And you never actually end up using your business for what it's built to do, which is support you as the owner. It's great to have a big mission, and so we have a mission. We're going to save $1 trillion, but it's also got to support everybody working here, including me as the owner. So that's just something to be really, really mindful of. And you know, I can give you some good just rules of thumb. So one is that you wanna separate your expenses into service fulfillment. So uh, or service or product fulfillment, so cost of goods kind of stuff, acquisition costs, and then operational costs. So those three different major categories on your expenses. Your acquisition cost is really important to keep an eye on. The LTV to CAC ratio needs to be at least 6. What that means is if I spend $1,000 on something, I go to a conference, I do marketing, I build a new widget, whatever it is. If I spend $1,000, that needs to bring in at least $6,000 worth of client activity or customer activity. Now, it doesn't have to be all at once. It can be, $500 a month for 12 months. But eventually, I need to get a 6x return on that in order for my business to work. And the operational expense needs to be 30% of my revenue or less, which is usually pretty easy actually. In modern economies, so many people are doing service-based businesses. Generally, expenses run about 15-20% of revenue, and then the real revenue you have to look at is your gross profit after your cost of goods or cost of service fulfillment. So that's the number you want to take for those ratios. So so I know that's a whole bunch of numbers, and I've got a worksheet that I walk people through as far as their profitability calculators. So we had one a client last year. They came in, they were doing e-commerce stuff. E-commerce is a miserable business. You have to do enormous volume in order to make any money because the margins are small. So, we walk through their product line and says, okay, you've got this low price stuff, you got this high price stuff. Here's the ratio of, I sell 10 of those for one of those, that kind of thing. And it's like, how much do you want to make out of this business? It's like, if you want to make 50 grand, you would have to sell, and I forget what the numbers are off the top of my head, but it was some astronomical amount of money or amount of volume in order to generate $50,000 worth of actual profit that they could then live on. And it was a husband and wife, and they looked at each other and it's like, yeah, there's just no way. So it's like, well, that's good information to have because then you can pivot and do something else with your business that is actually going to work or could potentially work. So Whenever people talk about reinvesting, it makes me leery, I guess is the word. Because if you're reinvesting, that means your business is probably not profitable enough, and that's something to fix rather than something to encourage.
Alrighty, sounds good. So we have a lottery question.
Lottery?
Uh-huh. Yep.
Okay.
So a client wants to know, how does winning a prize or a lottery affect your taxes?
Poorly.
Yeah, I was going to say that too.
Yeah. So, when the Mega Millions got up to $1 billion, whatever, I bought two tickets, you know, just in case. Um, so yeah. So when you win a gambling thing, could be lottery, could be poker, it could be slot machines, whatever, you're gonna get a W-2G. And it's going to have the W-2G has a whole lot of information on it. The two important parts of the information is the prize, how much you won, and withholding. So depending on what gambling thing you're doing and where you're doing it at, they may or may not have withholding. So I'll tell you, the largest W-2G I ever saw was a client comes in. He was a new client that year, and he comes to this is at my old office, and he comes in, he sits down, his papers, and so I'm going through. He's got a W-2 job, he's making a normal kind of medium amount. He's got a mortgage, interest or whatever. Just kind of flipping through stuff, and there's a W-2G, and it's a one followed by six zeros as far as the prize goes. So, and he didn't mention any of it, right? He just said, "Here's my stuff," and it turns out he won $1 million. So that was one of the times the Powerball got real big, and he had gotten all the numbers except for the Powerball. And if you do that, it's a flat $1 million prize, and they withheld 20% on him. And this was in Florida, so there's no state income tax problems. So they withheld 20%. So he got a cash payout of $800,000, and he bought a house, and he was like the smartest lottery winner I've ever seen. He bought a house. He did, and then he put the rest into like a managed investment account, like 400 or 500 grand. And that was it. He didn't quit his job. He didn't change his life. Well, no, he did get married. So he did do that. And I was a little skeptical of the wife, to be honest. But
Yeah, I was going to say that too.
well, to each their own. I don't work in that office anymore, so who knows. Uh, so yeah, he kept his job that he was working at, and now he just has this paid off house, which he then later paid off, and then he's got this decent sized brokerage account. So he took, I think, maximum advantage of it. The problem though is that 20% is not enough, right? So when you have higher income, it pushes you into a higher bracket, then your tax rate goes up. So he was above the 20% on average. So he ended up having a tax bill that year. And there were some things we could do. We were able to, reduce that a little bit, but by and large, he was a little bit stuck. So the thing with gambling winnings is that, a lot of them, like if you have a poker winnings, they're not going to withhold anything on you. It's just going to be whatever the prize amount is. And so you just have to plan ahead, knowing that I have this income event. It's going to throw off all my other income as far as brackets go. It's going to throw off my itemized deductions if I have any. And then when it comes to gambling, there is a potential to deduct losses. So the losses is kind of a weird thing. So number one, you're only allowed to deduct up to the amount you win. So if I win 10 grand, then I'm only allowed to deduct 10 grand in losses, even though I actually had 15 grand in losses. So that guy who won the $1 million, he bought two tickets. He never played again. He's the only person I've ever seen come out ahead on gambling or lottery or anything. Everybody else loses money. So, um, so if you have winnings, you can deduct up to the extent that you have losses. However, the the losses go on your Schedule A, which is your itemized deductions. Your itemized deductions are not a one-for-one benefit because you have to overcome the standard deduction first. So 2025, if you're a married filing joint filer, you get a $30,000 standard deduction. And so your mortgage, your medical expenses above 7.5% of your income, your state and local taxes limited to $10,000, your charitable contributions, all that would have to add up to $30,000 before any gambling losses would start to offset one for one. So even though you might have gambling winnings and gambling losses, a lot of times because of that standard deduction hurdle, the gambling losses don't actually help you at all. And you end up just paying taxes on the winnings, even though you then lost it. So that could be a major issue when it comes to gambling winnings. So, one of these days I will write my book about the 16 things I learned about you by doing your taxes. One of those things is that nobody can afford to gamble. So it just doesn't pay. I had another guy who is a real estate guy, and he had a bad year real estate wise, and ended up spending a whole lot of time at the casino. And he comes in with these. So the W2Gs, every time he won like a roulette or a slot machine thing, you got a slip of paper. He had stacks and stacks of these papers, and I was going through and I was adding them all up, and there was literally hundreds of these slips of paper for this client this year. And I told him, it's like, hey, so this was all the same casino. So I said, go to the casino, get your win-loss statement, because whenever you use the gambler's card to get the special perks and everything, they keep track of all that stuff. Because what I don't want to happen is I don't want to have us be missing one of these slips and report the wrong number. So he did that. He came back and everything, and he's telling me all this stuff about, it's like, yeah, I closed these houses while I was at the craps table, and did this that and the other, and I had a system, right? Everybody has a system. So so it's like, okay, that's great. Yeah, yeah. So I get the win loss statement from the casino. But sure enough, he grossed $1.8 million worth of winnings. He did do that. Yeah, and he lost like 2.1. So he was upside down 300 grand. And um, it's just like people will tell themselves all kinds of stuff, when it comes to gambling, because it's addictive behavior. So you know, no matter what you think is happening, the numbers are gonna tell you the truth. And the casinos have the big buildings because they make the money, right? That's fundamentally how it works. So, don't gamble. If you are gambling, you should stop. The only exception is if it gets to be some outrageous prize, you can bet $5 on it, assuming that won't trigger something, inside of you. So yeah, just stay away otherwise. Um, but yeah, so how does gambling affect your tax return? Poorly is the answer. It's going to cause it will often cause phantom income because you already spent it and lost it, but you can't deduct the losses because of that standard deduction issue. Um, and the withholding on it is usually bad. So it's either 0 or 20%, which is generally not enough.
Wow.
So that is gambling. I have no like moral problems with gambling. It's just a bad idea.
Right. So I'm pretty sure the ones that win on the lottery and then they say, I'm going to take the taxes up front, right? That 20%. They probably think it's over. Like, I don't have to
They
pay any more
do.
taxes.
They think it's
and I'm
over. They
good.
said they withheld. I'm fine. I can spend the rest of it. Not the
Wow.
case.
That's sad.
Yeah. So if you do win the lottery, the first person you call is an attorney. Second person you call is your tax accountant. So,
Yep. Sounds good.
yeah.
Looks like we have a real estate question.
All right.
Someone wants to know what are the tax benefits of owning a home versus than renting one?
Yeah. So not as much as it used to be honest.
That's true.
So in the old days, when the standard deduction was lower, then it was much more beneficial because on your itemized deductions, again, same thing with the standard deduction versus itemized issue. For your personal residence, you get mortgage interest, at least for mortgage amounts that are less than $750,000, and property taxes. So those two become deductions. They both have limitations on them. And in order to exceed the standard deduction is much less common than it used to be when the standard deduction was lower. So under the old system, we had exemptions based on the number of people in your tax family, and then we had a standard deduction. And in 2017, they got rid of exemptions and they doubled the standard deduction. and the standard deduction has grown every year since because of inflation adjustments. So, so relatively few people these days can actually itemize their deductions. So the benefit of buying a house for tax purposes for a personal residence is much more muted than it used to be. Now, there are other advantages. Obviously, you have a thing that you own. Your rent is not going to go up on you, assuming you have a fixed mortgage, or your cost of living is gonna remain relatively the same. Um, so there's all these different other advantages, but for tax purposes, not as much. However, if you move out of that place and you turn it into a rental, then there's a whole lot of tax advantages. So rentals are largely advantaged in the tax code because of things like depreciation, where you can write off a chunk of the cost of the structure due to wear and tear over time, and there are different games to play with that, with cost segregation and other things that are super helpful. So personal residence, not so much. Investment property, lots of advantages.
Okay. So it looks like we have another real estate question. So someone is thinking about getting into investments, and they're trying to figure out if they should invest in a property for a long-term renter or an Airbnb. What do you suggest them to do?
Well, I don't suggest either one because I don't make recommendations, but there are different pros and cons.
Okay.
So, um, advantage to the short-term rental is that if the average stay is less than 7 days, a it is not a rental activity, which means it's not passive, which means you're not subject to the limitation on passive activities. So, um, let's say let's say you're married, you and your spouse, between the two of you, you bring in $150,000. And then you have this long-term rental real estate where, rent is 1,500 bucks a month, 18 grand a year. You have expenses, you have depreciation, and by the time it's all said and done on a tax basis, you have a $10,000 loss. So 150 grand day jobs, $10,000 loss on the rental. You would think that, okay, I made 150 here, I lost 10 here, my net should be 140. And you would be wrong because there's this thing called the passive activity loss limitation. So if you make over $150,000, between all sources, then the amount of loss you can take from passive activities is zero. If you make less than 100,000 from all sources, then the passive activity loss you can take is limited to 25,000. So and then as you go from 100 to 150, it scales down until you hit zero at 150,000. So that's one of the challenges with long-term rentals. Now, there are ways to get around that. There's material participation, there's real estate professional status, and other things. But that's the kind of the base scenario. If you're doing short-term rentals, then the passive activity loss rules do not apply because you're effectively in a trader business you're in the hospitality business. So it's not passive and those rules don't apply. So if you have a short-term rental with average stay less than 7 days, same numbers. I make 150K between me and my spouse's day jobs. I lose 10 grand net on a tax basis. And so now my net really is 140 and my taxes are lower and we have larger refunds or owed less or whatever the case might be. So that's the major advantage to short-term rentals. So because of that active nature of it, it allows for deductions when you couldn't have deductions otherwise. It also allows for just automatically it allows for cost segregation strategies where you can accelerate the depreciation by breaking up the property into its different components and then depreciating them all quicker in early years and have less depreciation in later years. And time value of money, a depreciation or a deduction now is worth more than a deduction 30 years from now. So that's the advantage of short-term rentals. The disadvantage of short-term rentals is that it's a lot more work. When the IRS has their rules that it's not passive, they are actually correct because it is not passive. So whether you're doing it yourself or whether you're paying a manager, the managers will charge a lot more. So long-term rental, a manager will charge you 8, 10, 12%. Short-term rental, a manager will charge you 30%, 40%, and they do that because it is a lot more work. So, you have to factor that in. Now, in the right markets, I have seen short-term rentals be wildly successful. In the wrong markets, I have seen them be wild failures. So, your rewards are higher, but your risks are higher. So there's that. Now, the advantage of long-term rentals is that, fundamentally, worst case scenario, you have tax-free income. So whatever cash flow you get out of the property, because of the depreciation offsetting, even if you're not able to offset other income, you're still not going to be paying taxes on that cash flow you get from that property. In most cases, asterisk with that statement. Um, so so there's that. It's a much simpler business to operate. It's a much simpler thing to do. And, fundamentally what you're doing is you're building um, equity over time. And so, hopefully you get some cash flow as well. That'd be great. And you want to get at least some positive cash flow to build your reserves for that property, when you have to replace the roof or water heater or whatever. But, if we're talking about one property is, or one single family house is not going to retire you. So if you have 10 of them or 20 of them, then yeah, then you can talk about quitting your day job. But if you're making $300 a month net after all expenses are paid, then it takes a lot of those. But what you are doing is you're building equity because as you have a mortgage, you're paying down the amortization on the loan. The property is probably appreciating just due to the nature of inflation and the fact that we have a growing population, assuming you buy in a somewhat desirable area. So that's the long-term wealth play. So short-term rentals have some tax advantages because of their short-term nature at the expense of a lot more work. Long-term rentals have fewer tax advantages, but are much easier to operate and are building that long-term asset. So the short-term stuff, if you're in a vacation area, a lot of those will buy and sell as a business, meaning that it's dependent on the net operating income of the property. So like I was looking at a guy who was building cabins in Gatlinburg, Tennessee, the Smoky Mountains. It's a very popular thing to do over there. So just know that it's a different beast when it comes to buying and selling as far as like what they're going to cost, because it has this business element to it. Now, and then there's some crossover there. If you're doing short-term rental in a normal or long-term kind of area, then you might get some single-family house type appreciation, even though you're operating it like a business. But real estate's very local in terms of how everything prices. So you got to be aware of what you're doing, basically. So, but that's the two basic elements to short-term versus long-term rentals. They both work. They both have different advantages and different disadvantages. And again, we don't make investment recommendations.
Understood. Understood. So we have a question about RMBs. Someone wants to know what should people know about required minimum distributions, RMBs, and taxes?
Yeah, so required minimum distributions. So it used to be once you hit age 70 and a half, if you had money in an IRA or 401k or whatever, you had to start taking money. There was a bill a couple of years ago that changed that to 72. So now it's 72 instead of 70. And basically, if you put money into a tax deferred plan, like a 401k, traditional 401k, traditional IRA, traditional SEP, traditional this, that, and the other, that means when you put the money in, you got a tax deduction back then. And the deal is when you take it out, you have to pay taxes at that future date. And they want to make sure you start taking it out. So that's where the RMD comes in. Basically, they'll look at your account balance and they'll look at your age and they'll do a calculation. There's a table based on your age and what percentage of the portfolio needs to be liquidated and distributed so that you pay tax on it. Basically, it starts off at like 4%, and then it graduates from there. I think if you're like 96, it's like 50% has to be distributed. So basically, they want to make sure that the tax eventually gets paid. So, um, and you don't have a choice about this because it's just the law, and every administrator of retirement plans will do this whether you want to or not, because they don't want to get caught up on, penalties and things for not complying. So you'll get a notice from, Administrator X, and they'll say your RMD this year is blank, and where do you want it sent? That's the extent of the questioning that they do. So it is taxable income, just like if you had profits from a company. You do not pay employment tax on it, so you don't pay Social Security, you don't pay Medicare, but you do pay income tax on it. If you have enough of it, you might pay net investment income tax, or you might pay additional Medicare tax. But you have to be up in six figures before that happens. Um, so that's just something to be aware of. Now, there are things to do with RMDs. So think number one is that if you have multiple accounts, the RMD for you specifically is based on your global portfolio value. So if you have different accounts that do different things, you might want to take your RMD from account number one and have that satisfy your total obligation for the year, and leave account number two and account number three alone with no distributions. Now you have to coordinate with the administrators to make sure that that happens, and so that they all know that the RMD is being satisfied just by this other account over here. But you personally just have to make sure that you take a total value from your total accounts. It doesn't have to be RMD per account. So that's something that people don't understand a lot. Another thing you can do is a QCD, which is qualified charitable distribution. So if you're over age 70, and if you're in RMDs, you're automatically going to be over age 70. Then and you are charitably minded and you're giving cash to charities, you can have the administrator send the money directly to the charity. And that money never hits you personally, because it didn't go to you, it went to the charity. And the money that you contribute to the charity through that distribution counts towards your RMD. So let's say you have an RMD of $15,000 this year, and I'm going to give five of it to whatever, Humane Society. So I tell my administrator, hey, give 5,000 to these guys over here, send it to them, and then give me the 10, and then I'm only going to be paying tax on the 10. So that's a more efficient arrangement, as opposed to taking the 15 and giving 5. And it's because of that standard deduction, itemized deduction hurdle that we talked about earlier. Same issue. So if you're charitably minded, again, don't let the tail wag the dog, but if you're going to give money anyways, give it more efficiently, do a QCD. And then the other thing is that inherited IRAs under the Secure 2.0 Act, there was a little bit of confusion about this, and we finally got some regulatory clarity over the last year or so. Basically, if you pass away and there's still money in the account, it's going to go to your heirs. Let's just say it's one heir for simplicity. That heir is required to take out a 10-year series of RMDs that's going to drain the account balance. So even though you got away with not paying tax by passing away before all the money came out, the person who inherits that account is still going to have RMDs for 10 years to drain the account to make sure those taxes get paid. So if you do traditional plans, that's the deal. You're putting in money up front, tax break at that point, tax hit on the back end when you take it out. Now, the alternative to that is a Roth arrangement where you're putting in money after tax. So there's no tax break up front, but similarly on the back end, there's no tax impact, there's no tax hit, and there's no RMDs because of that. So just the different approaches, and depending on your age, Roths might not have existed back when you were putting that money in, but now they do. So if you're a young person at this point, you can think about, like, do I want to have a tax break now and tax hit later, or do I want to take a tax hit now and not have a tax hit later? So that's the fundamental choice. And the answer depends on your assumptions about future rates of growth, future tax rates, and what your lifestyle is going to be. So it's all a bit up in the air, to be honest, as far as what your assumptions are going to be and how that models out as far as which way comes out better.
Okay. Um, next question is, how does the IRS handle tax debts, and what options are available for taxpayers struggling to pay?
Yeah. So, how do they handle debts? They want you to pay them. That's
Yeah, that's true. Yeah.
so. I mean, it is more complex than that, but that's the fundamental thing. So, if you owe a tax bill, let's just stick with the IRS because it's just the one instead of the 50 different states. Um, if you owe money to the IRS, they want their money. And let's also assume, for the sake of this discussion, that it is the correctly calculated tax. If something was filed wrong or any number of scenarios that can be fixed, then fix it and the problem goes away. On the other hand, if you file something and you do owe money and that's just how the cookie crumbles, then you have options. Option one, if the debt is less than $50,000, you can just get on an automatic payment plan where they'll structure it over 6 years. And it doesn't save any interest, but it does save the hassle. You won't get letters or anything like that. Um, and if you set up one of these payment plans, then you can and you're up to date with it, then your future tax returns, if you get a refund in that future year, they will actually send you the refund. If you have a debt and you have not paid it and you're not on a payment plan and you get a refund in a future year, they will take that refund and apply it to that older year. So that's option number one. Options number two and three are the stuff you hear on TV and on radio commercials and stuff, where it's like, if you owe at least $10,000, blah blah blah. So what those people do is they submit what they call offers in compromise or currently non-collectible applications. So if you have a debt and you can prove to the IRS that you cannot pay it, then they can potentially give you a break. Um, so basically, the application process between those two things is very similar. Effectively, uh, you list out all your assets, and they do some modifications of the assets based on, like, they'll leave you $1,000 in your bank account. If you're selling a house, they'll leave you like 20% equity, because there's selling costs and all this kind of stuff. And if at the end of those calculations, plus whatever employment that you have, and expenses for normal cost of living with your given family size, it's a whole thing to do. But if you go through that whole exercise, and there's a form, it's something OIC. Can't remember the number of the form, but there's a form, and if you go through all that, and the number it comes to is less than the amount that you owe, then you submit that and say, "Hey, can I pay this lesser amount?" And if everything checks out, then they can grant you that, and you can pay less. For currently non-collectible status, the process is effectively the same, but the number you come to at the end is zero. It's like, I got nothing. I don't have any assets. I don't have any income. I don't have any money in the bank, so I can't pay anything. And they will put you on a currently non-collectible status. Currently is an operative word there because if circumstances change, they will reopen your case. So you gotta stay that way. Some people try to stay that way for 10 years to run out the statute of limitations, and then after that, then they can apply an affirmative defense saying that, hey, statute of limitations has passed. You can no longer collect this from me. IRS is okay, and then they can start making money again. It's a miserable way to go. I don't I don't recommend keeping yourself in poverty for 10 years just to avoid taxes. So that's options two and three. Option four is if it's over the $50,000, then you have to go through the manual process of getting on a payment plan. Option five is don't do anything and just kind of pay as you go, and you'll get letters every month saying, "Hey, your additional interest is now this, and your total amount is now due that," and that's the highest hassle way to go because you'll keep getting these letters, and you'll keep making payments as you can, but it is a way to go. So, by and large, the vast majority of people who find themselves in that situation just need to get on a payment plan and keep up to date with that. And you'll be on that 6 year plan trajectory. And just as long as you stay current with that, IRS is fine with it. Again, it does not save you interest, but does save you, hassle. And the companies out there that do all the advertising for the for the offers and compromise and the non-collectible stuff, they'll charge you, I don't know, 3 grand, 5 grand to do it. And to be fair, it's a lot of work. So I don't actually begrudge them that, but the things that they advertise are not typical situations. Most people who submit offers and compromise get rejected because the numbers don't support it, and that's just how it is. We had somebody last year, the year before, between it was a married couple, between the two of them, their W-2s were 300 grand. It's like, hey, can we put in a offer and compromise? I said, no, you can't.
I remember that.
Because you make too much money. So they're just not going to. I mean, you could put one in, they'll just say no. And that's it. So let's not waste our time.
Right.
But, the fact that you didn't do good withholding is your problem fundamentally. So you want to work with your. I guess the big takeaway of all of this is that as things happen, you want to work with your tax professional, whether it's us or somebody else. You want to work with your tax professional in order to establish what is going on tax-wise. How does this hit you or help you or whatever? And then so by the time you get to the end of the year, there's no surprises. All right. That, when I talk about our four-step process, a lot of times I talk about tax peace, and the peace comes from not the fact that I don't owe anything ever. It comes from the fact that I have, my expectations matches reality. And so there's no nasty surprises at the end of the year. It's like, oh, I think I'm going to pay $15,000 and I pay 14,872, whatever the numbers are. So that, as you go through the year, then you adjust and adjust and adjust. And so that by the time everything is done, then everything is as we expect. So that's really the goal. And if you only have one job, you get a W-2, and there's kind of nothing else going on, then as long as you have your withholding set up right, that should be fine. But if you have more complicated stuff, I've got investment income, I've got this real estate property, I have my own business, income's up and down, all these things require monitoring and maintenance, just like anything else. So that's what it comes down to. And that's what everything depends on. We were doing the books for a client. We brought on a new bookkeeper, Sammy, and he was saying, it's like, oh, we had this alimony payment. I said, alimony payment? Did so and so get divorced? He's like, yeah, I called him up. He's paying alimony. It's like, wow, that's gonna change things. So that's, all this stuff has an impact on your tax life. So when you want to know what it depends on, become an explorer. And this is our group. It's free to sign up. You'll get our emails, you get access to the show, and more importantly, you get all of our tools. Some of our tools and courses are free for the explorers. Some have a small fee. If you join our navigators, which is our premium group, everything's included, and it's actually worth it to join the navigators instead of just the explorers if you want to buy any of the paid stuff. But there's plenty of free resources as well. My favorite one that I use all the time is the quick and dirty bookkeeping method. So it's an AI powered system where you upload bank statements and it'll actually categorize everything for you. Only works for simple situations, but if you have a simple little side business or sole proprietorship or something like that, works great. And then you take the output from that, you put it into a pre-formatted sheet that I provide for you, and it'll create a profit and loss by month. And takes 5 minutes to do 1 month's worth of bookkeeping, if that situation applies to you. Because again, it depends. It's not going to book assets, it's not going to book liabilities, it's not going to book accruals or anything like that. But if it's just cash in, cash out, which is what most small businesses do, works great. All right, so that brings us to the end of the hour. And so next week we'll do it all again. That'll be the 21st. 6 p.m. Eastern is when we do this. Just as a recap, January 27th is when IRS opens for e-filing for individuals this year. March 17th, that's your partnership and S Corp returns. April 15th, that's your individual and C Corp returns. And again, if you do extensions, that's fine. For all of our clients that are already in our system, we start filing extensions in February for corporates, just because we don't want to get caught on those. Even though sometimes, and this has become more and more of a problem the past couple of years, I don't know why, but sometimes we'll submit an extension, it gets accepted, and then 6 months later we get a letter saying, "Hey, we didn't accept your extension." What are you talking about? We've been filing this way for 3 years. But that's my own cross to bear, I suppose, having to deal with the IRS on that kind of stuff. But so those are the important dates. And if you do extensions, again, extension is extension to file paperwork, not extension to pay. And if you end up in one of those situations like Serena was just talking about, where you're going to end up with an amount you don't have the cash, at least pay something, get as much in as you can to reduce your fees and everything on the back end. And then once you file the return, you can get on a payment plan at that point. So that's all we got for this week. We'll see you guys later.
All right.